No. This is a good level. I think the way to look at it is I think the market really reacted when oil got over $100 a barrel here in the U.S. The gasoline price got over $5 a gallon. Consumers reacted. They didn't drive as much, and that resulted in lower demand. But then once oil prices came back down, gasoline prices came back down, you've seen the consumer come back and continue to drive and drive their cars, and really demand's been pretty resilient despite what's going on in the broader economy. And so if we can keep oil prices, below 100 and in that $80, $90 range, natural gas prices can come down a bit as well, probably in that $5 to $6 range. That's really the sweet spot for energy companies to really deliver pretty strong returns and once again, deliver lots of dividends back to shareholders.
Yeah, in that kind of an environment, if that's what we're in for a while, what particular names are attractive right here? Are you looking to play leverage to the production cycle or just more cash flow?
Yeah, so Mike, what we like at Tortoise is energy infrastructure because there's less of a leverage to the commodity price, more of a leverage just to volumes. And so companies like Cheniere Energy, which is the leading LNG operator that's really going to benefit from decades worth of LNG growth globally. It's one of our favorite names as well. Energy Transfer is another one. It's an 8-9% dividend yield. It's going to grow its dividend, keep its dividend growth up with the pace of inflation. So investors can get a really healthy dividend yield from a really quality company that's been decreasing its debt pretty substantially over the last several years. Oil producers or natural gas producers, EQTs is one of our favorites. You probably had Toby Rice on the show or listened to him, but he's one of the top really natural gas executives and really energy executives in the U.S. EQT is the largest producer of natural gas really in the U.S., and we just see natural gas as playing such a critical role globally as well as domestically over the next several decades.
I mean, with Cheniere in particular, clearly right at the center of so much that's been going on in terms of the LNG market and exports to Europe and all that to meet their heating needs. Stock up, though, 70% in a year or something like that. Is there more left?
Oh, yeah. Well, when you look at the outlook for Cheniere going forward, as far as the cash flow that the company can deliver, this company just turned into really an operating company a few years ago as a construction company for several years, building this massive LNG infrastructure. And now it's going to spend several decades really harvesting the cash flows from that capital investment that just occurred over the last several years. So there is a significant amount of cash flow. The company's been paying down debt very rapidly, getting it to a level where the company will likely become investment grade very soon. But in addition to that's not only the only thing that Cheniere's doing. It's increased its dividend pretty substantially, made it competitive with other companies in the S&P 500. But more importantly, it has a lot of cash flow to buy back stock in the case that the stock would decline, or even at these levels. The company is likely buying back stock even at these levels. So we just see a really strong free cash flow story out of Cheniere, a free cash flow yield that's double digits. And if you look at a free cash flow yield double digits relative to the S&P 500, that's 5%. That spread is way too wide. So we see, obviously, that spread narrowing, which means the Cheniere price probably goes higher from here.